Hello, everybody. I'm Niall Alexander. I'm the Credit and Consumer Market Lead at Fair for All Finance. Our role here involves seeking to change the way the financial system works, specifically the products and services that it offers to everybody, including within that the 20 million people that we've identified in our segmentation work as living in financially vulnerable circumstances. There are links to that segmentation work on our website. I spend much of my time looking at the credit markets, who's taking credit, how much, from where, what their characteristics are, who's been declined for credit, that type of thing. And we've been steadily coming to a view here at Fair for All that the shape of the credit market is as important as the size of the credit market. We think that credit availability across all income levels and across all tenures is important. And we have some concerns at what will happen when that shape of the market starts to mean that access to regulated legal credit is harder to obtain for borrowers. What happens to them? That greater difficulty is, I'm afraid, already evident. Of course, goes without saying, going to say it anyway though, that credit is not a panacea for people. It's not a substitute, particularly in difficult times, for better wages, social security support, savings. But in general terms, we like credit, where it's affordable, where it's appropriate, and in many cases we see credit playing a valuable and valued role in communities. That's certainly my experience. I think that the impact, the social impact, the positive social impact, the positive financial impact of credit is often underestimated. The environment that we are living in 2024 continues to be difficult for millions of households. The talk of a cost of living crisis has kind of abated a little bit, hasn't it, in the media recently, but it's not disappeared. It has certainly not disappeared for millions of people for whom there is absolutely still more month than money in their paycheck. If you don't believe me, just think about your car insurance renewal premium, think about your home contents policy, think about your weekly food shop and the price of that. The context, though, is difficult, particularly for lower income households. And I'm talking about the kind of bottom 4 income deciles. In 2024, food parcels in 2024 are delivered every 10 seconds in the UK. Half of all the clients seen by Citizens Advice are in negative budgets, and that's after they've been seen by advisors, not before. And the ONS say that between 2022 and 2023, we witnessed the largest one-year drop in living standards in that phrase since records began. And in this case, records began in the 1950s. So it's really difficult for millions of households. And yet, outstanding consumer credit is back to levels that we saw before the lockdown and the pandemic. This chart takes us up to December 2023, and it shows that there was £150 billion outstanding consumer credit, with a further 70 billion outstanding on people's credit cards. So as we talk today, though, that figure has risen further. It's another 10 billion since. So it's now 160 billion of outstanding consumer credit. But behind that, you want to know who's taking that credit. Is it spread across all incomes and across all tenures? Our evidence that the credit market is not working as well as it could for everybody comes from our own research. We commissioned Ipsos to undertake a nationally representative weighted sample about people's credit use. It also comes from our relationship with a company called Infineon, who run large aggregator sites, where we analyse with them the characteristics of people using those sites online and the offer rates that they get. It also comes from research done by people like LEK, ClearScore, EY, Apex, JRF, you name it. There's an awful lot of reports out there about what is happening with credit in the UK. Because we work closely with community finance, they tell us too about the declines that they are seeing for credit more than ever before. We see people, though, in our research, decline for credit, then facing difficult choices, which means sadly that they are much more likely to go without food, turn off their utilities, miss bills, pawn possessions, use their savings, often meagre, before turning to friends and family, and worse, using illegal, unlicensed loan sharks. That evidence is detailed in our report, Access to Credit and Illegal Lending, which is available on our website. And we'll also very soon share some further data that we are compiling with Infineon. I'm not saying that we go back to the days of unfettered access to credit. Not at all, not at all. Regulation is important, scrutiny, better customer outcomes. They've been a big part of the last decade in credit use. But it is true, though, it is true that a decade ago, forms of credit predominantly used by people now increasingly denied credit, who were social renters, lower income households, lone parents with children, younger people, they represented around 4% of all outstanding credit. That's home credit, high cost credit, rent to own. That's now under 0.4%. Now, buy now, pay later, of course, has taken up some of that slack. We don't know exactly how much, but some of it has absolutely been taken up. And we join calls for its regulation. And when we see that regulation, of course, that will also begin to deny people access to credit there. A good thing in some cases, not so good in others. But we still think there's an issue with who is unable to access credit. And we are concerned, and we all should be concerned about what that means for people's choices thereafter, because people need solutions to problems. Our work and others' work suggests that there's a much higher use of friends and family borrowing. Our figures there are, 23%. Is that what that says? 13, 20, no, it's not. It's 22%. 22% of people using had borrowed in the last year from friends or family, either sums over or under £250. The FCA's Financial Life Survey shows us that in 2017, when you work it out, 1 in 12 people with a household income under 15,000 were borrowing from a friend or family, and that's increased in 5 years from 1 in 12 to 1 in 6. So we also know that the illegal money lending team believe that when you say you're borrowing from a friend, that masks some illegal activity, and we've researched that as well. Our Ipsos research indicates there's a growing issue of illegal lending activity within communities, and we've got 2 reports on this, both of which are available on our website, and we call for a greater role for the illegal money lending teams to investigate just how bad this issue has become. So what are we to do? It's a difficult problem. There's no easy answers, but a big part of what we do is scaling up community finance, as credit unions, CDFIs. Community finance are still getting in difficult circumstances, small sums of money, often under £1,000, to people in rented accommodation, invariably on a lower income, often to people with dependents, the very people who are missing out elsewhere. It needs to be supported, it needs to be expanded, and we are using our resources to support that activity. There is, of course, a role for banks there, potentially in supporting that activity, or potentially lending the money themselves. And we absolutely accept, though, that there's, as I say, no easy answers to this, but there's a role there. There's a role for regulators. Access is important. Protection is important, but so is access. We've seen banks in the United States begin to offer what they call small dollar loans to customers with thin files, poor files, and the results there look encouraging. Bank of America, for example, has lent $500 million, they say, to over 1 million people who they otherwise wouldn't have done so without the small dollar loan scheme. We'll do more work on this in the coming months. As I said at the beginning, it isn't for everyone. Credit is not for everyone. Safety nets are important, support's important, advice is important. They all matter, absolutely, and we encourage more investment in those. But ensuring people can access credit with proper protection, properly regulated, legal credit, fair credit, means that there has to be a spectrum of players who are involved in this, from community finance, the mainstream banks, to even high-cost credit itself. And they should all be involved. We will keep looking at this. We will keep supporting access to community finance and other aspects of credit. We are encouraging others to be in that space where they can. We think there is more to do. Thanks for listening.